Hey, Michael, how did you feel about the move in Switzerland?
Well, I think we're still evaluating the longer-term effects, but I don't think it's unexpected. The Swiss National Bank made a move earlier in the summer with the rise of the franc against the euro and the dollar, and that rise has continued. And, you know, what that means for the Swiss economy is that their exports are getting more expensive, and it's starting the rise of the franc for the rest of the world to guard against inflation and other economic problems is the Swiss problem in terms of their own economy slowing down because of it. So they had to do something. I don't know what the long-term effects would be. Possibly people may move to gold instead of the Swiss franc, but that remains to be seen. I don't think it's going to have a material effect long-term.
Really? Because some investors are calling this the major foreign exchange event for this year, 2011. And the Swiss Central Bank says they will sell as much currency as they can to keep the franc at these levels that they're comfortable with. That sounds like a pretty threatening words, don't you think?
Well, I mean, you're talking about the first day of the announcement. I think the more that they sell and the more they devalue the franc, tends to devalue the intangible asset that Switzerland is for a lot of investors around the world. So I still think they're going to be very careful to manage that asset. So like I said, the longer term remains to be seen here. The other thing is that if currency pressures alleviate, they may not need to do as much as maybe they're announcing right now.
Okay, so let me ask you this. In terms of running for safety, would you still get into the Swiss franc?
Yes, we will. It's a part of our strategy. We still like the risk reward of the franc versus other currencies and countries. And like I said, I still think it's a good place to go to hedge against the declining dollar and other major currencies. So yeah, we still will be investing in it, and we still will be doing other non-currency investments like, say, gold and silver.
What about treasuries? Basically, it's at record low yields. You're getting 2% on your cash for 10 years, basically nothing for 2 years, but yet people still pile in. What's the thinking here?
Well, the risk reward is getting very difficult to justify. I mean, we were buyers of treasuries earlier in the year. Not so much lately with the recent rise. However, we still do use them as a part of our diversified strategy to guard against deflation, recessions, economic downturns, deleveraging of assets. And unfortunately, those risks are still out there around the world, and I think that's one reason why investors are continuing to buy treasuries despite the very high historical prices. So they could go down further from here. I think if investors are willing to take on a little bit more risk, U.S. stocks might be a better place to go because you've got potential growth and you've got dividend yields that are starting to far outpace bond yields at this point.
Yeah, Michael, let me talk to you about the state of global markets and the economy, because we're hearing some scary assessments. You heard now Ferguson, of course, from Harvard University, saying it's reminiscent of the 1930s. And then Deutsche Bank's CEO, Joseph Ackerman, saying it's all deja vu of 2008. Do you think we're going to get into recession here across the globe?
Well, I've heard those comparisons as well. And I mean, I think the 30s comparison relates to the fact that we had some growth and then backtracked a little bit in the late 30s and 37 and 38. That appears to be maybe what's happening in the States here, although I think the periods are very different. And you got to be careful to just label them as the same. They're not. Corporate America, profits in corporate America have been very strong. And, you know, while global growth may slow, it's still there. And U.S. companies are poised to take advantage of that. The employment sector, while unemployment's high at 9% and some change, still nowhere is anywhere near what it was during the Great Depression. And as far as the comparisons to 2008, no, I think U.S. banks are probably better capitalized back then, now versus back then. The issues in Europe are real, and some of the exposures are real, so it bears watching. But that event was an acute liquidity crisis that was brought on a sort of recessionary period afterwards. This one is a sort of anemic growth in the U.S. that we can't seem to ramp up or make more robust. And I think the big fault there is that fiscal policy has not kept up with monetary policy in the States, where there's not enough incentive for businesses to hire, not enough demand, not too much uncertainty in the regulatory environment, or too much negative sentiment on what's going on regulatory-wise here in the States. And so those things have tended to, even out or put at greater risk the lack of fiscal policy initiatives versus monetary policy.